Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
This is about as fast as inflation has ever fallen in the U.S., and we did it without a recession. That's what I call the golden path. It's not done, but it makes me feel a lot better when you both see it for multiple months in a row, and you see the components that you're finally starting to see the declines of housing inflation that we've been anticipating, and you're seeing improvement on the services side too.
I do think that as the Fed cuts rates, as we move out of this tightening period, that will give investors more confidence. It will make the cost of debt capital lower. It'll help transaction activity. I think it'll help the IPO market. And I do think the Fed is getting more and more air cover to cut rates. The Fed's medicine is working.
I think it might be an overhang on the stock until there is more clarity on the future potential for Domino's. I mean, Domino's historically has had in their international market a growth engine, so clearly fixing the United States was very relevant for Domino's in 2023, but all eyes and ears are going to be increasingly more into the international market. And so not having clarity on what the future potential might look like in terms of unit expansion might spook some investors.
We got 1 hour to go until the market close. So let's take a look at the major averages here. And I guess, I was going to say the rotation continues today, but it's only going out. It's not coming really back into something else.
And
so,
is that a rotation, really?
Or is it just a plain old sell-off? Maybe that's what we're looking at here today, with the Dow down 445 points, off 1.1%. The S&P 500 not down as much, but still down 0.75%. And the Nasdaq is down as well. So you don't see the kind of divergence necessarily that we've been seeing in recent days. And guess what? The money's not going into small caps. It's doing even worse, down almost 2% today.
Yeah, I mean, it's interesting. It's taking a rest there because, we talked about this, Julie. At the same time, we're down today, but that move was so sharp and quick and aggressive. And if it's still true, if you just backed it up, that's 10 days, even a week, you would see, still well in the green and solidly outperforming the SPY, right? So interesting where that trade heads from here.
Yes, and let's look at some of the other groups that we're watching here today. Now, I say the money's not really going into anything. It's going a little bit into energy and communication services today, but really small gains. Big selling in healthcare, financials, consumer discretionary. And then I wanted to dig a little bit into what we're seeing in tech here today. NVIDIA's coming back, which is kind of interesting. Meta's coming back. Tesla's coming back. But Apple's in the red, and there were some a tweet and a report today from a closely watched Apple journalist who said maybe those sales aren't coming back as much as people think they are. Alphabet, Microsoft, Amazon, they're all down.
You mentioned chips, which is because yesterday, the storm, getting whipsawed by these headlines, couldn't find a friendly politician on either side of the aisle. Today, relatively, if you look at the SMH, it looked like some relative stabilization, Julie. And I thought some of the moves were interesting, like NVIDIA having, getting here, Broadcom you can see up, and Intel, by the way, too, was also in the green. And Intel quietly over the past month actually up nearly 15%. And I kind of did wonder, just recently, are investors feeling like, well, maybe I'll be moving to Intel because at least I know CEO Pat Gelsinger, he's building out those domestic chip facilities here in the U.S., and so he stays on the right side of some politicians? Maybe. It's a theory. I don't know.
I like it.
All right. For more on the latest market moves, let's welcome in Ryan Grabinski, Managing Director of Investment Strategy at Strategas Research Partners, a Baird company. Ryan, it's good to see you. So you just heard Julie and I talking, Ryan. We're talking about, of course, the small caps. Ryan, investors have been talking a lot about those pint-sized companies, and they're down today, Ryan. But such a quick, aggressive move higher. I'm interested what you make of it, because your notes, Ryan, were interesting. When you look at that small cap rally, what you're suggesting is you really see it as kind of maybe more of a trade rather than the start of something bigger and broader.
Yeah, so it's first off, it's great to be here. Thanks for having me on. The one thing I will say about small caps is, I would say I'm probably a little more skeptical than most of the street right now in terms of the durability of the rally within the space. We've generally saw a 10% move higher here, and largely what that was it was a re-rating of multiples due to a reduced odds, I'd say lower Fed rate expectations, and that's a way of saying that the terminal rate for the Fed funds rate has come down to about 3.5%. So there were an additional 2 cuts that were priced in. So multiples, the NTM multiple for small caps basically jumped from about 22 times to about 24 times over the past week. What we didn't see was any follow through in terms of the fundamentals overall. So I look at the NTM EPS for both the S&P 600 and the Russell 2000, and it continues to be sort of on the low end of the range of where it has been. It really hasn't seen any uptick. So until I start to see some sort of fundamental follow through with regards to the small caps, I'm a little skeptical about the durability of the rally. Now, sure, I do understand that the banks make up a large portion of the small cap index, and everything that's going on in Washington, there's certainly some might be some regulatory reprieve that comes should the Republicans ultimately win and there ultimately be a Republican sweep. But I think that's probably more likely going to be a trade rather than an investment opportunity. There's not necessarily a story that would be associated with the banks more longer term, and so obviously that kind of hurts the small cap space overall.
So, Ryan, as I was just talking about, in recent days we've had this rotation, right, where things have come out of mega cap tech, out of some other winning areas, gone into places like the small caps. Today, it's not going much of anywhere in terms of winners, right? And so what kind of risk are we seeing from that rotation and the broadening out that could be supportive of a continued rally to just being a plain old sell-off?
Yeah, it's a great question. So one of the things that clients have asked me today is say, have we seen the top in the markets, this cycle, and are we in a bigger sell-off? So I think it's a good question to ask. I think there's heading into this earnings season, the earnings overall, the bar is pretty high for the overall index, I would say, especially on the large cap side of things. Obviously, there's been a lot of growth that's associated with the Magnificent Seven, and that's kind of where we're seeing that rotation out of. I'm gonna wait for the earnings season to really come about to get a better picture. Obviously, we saw the earnings report from ASML. Things were looking a little weaker. Their guidance was a little weaker. Thinking about TSM today, obviously things seem to be okay. So you start to think about, okay, have we had this sort of AI euphoria that the market has been facing over the last 6 months? Is that sort of turning into an AI disappointment? And so, I think generally speaking, that's the biggest risk heading into the next 6 to 8 weeks is, are we setting ourselves up for this AI disappointment, and do all of the trades that were associated with AI ultimately begin to unwind themselves? And that's not only associated with the tech sector, right? You had some of the nuclear companies had been associated with, okay, there's going to be more power demand, and that power generation is going to come from the nuclear space, and so those names have started to see a bid. The other trade, which I think it kind of goes underappreciated here, and is starting to see some of itself, is actually the sell-off related to the weight loss drugs. And so Lilly and Novo come to mind specifically there within the healthcare sector, right? They had accounted for a lot of the gains within healthcare, and to the extent to which that story starts to change, it may be it may not carry the sector. Obviously, healthcare hasn't been one of the great performing sectors this year, but Lilly has ultimately held it up more than would have otherwise been.
Ryan, over at Strategas, you work with folks who know politics in Washington very, very well. I'm just curious, Ryan, how the team there is thinking about the possibility of a Trump-Vance White House and what that would mean for the markets.
Yeah, so I don't want to speak too soon. I don't want to speak for our Washington D.C. team, but obviously we have to kind of get through the nominee portion. Obviously, we know who the Republican nominee is. Obviously, there's still some questions out there about who the Democratic nominee. I think ultimately, trade is going to be a big focus. Should the Republicans ultimately win the White House. Obviously, there's a lot of concerns about what that means for China and the tariffs. So I think that's also playing into some of the sell-off that we're seeing here with regards to technology. I'd say the other thing ultimately that comes up is, there's a lot of talk about what's ultimately going to happen with some of our closer trading partners like Mexico. Are they being used by China right now as a building block to kind of assemble pieces and then distribute them into the U.S.? Obviously, there's been a lot of foreign direct investment from China into Mexico, and will that ultimately come to fruition? Will that come to a head during, say, a Republican presidency? So these are some things that are left out there. I think the biggest thing will be ultimately on the tax front, which obviously we're starting to get ahead of ourselves when we really start to talk about that, just given the amount of events that are ultimately going to occur between now and actually the election, and then the investment implications will be even further on from there.
It's a long way between now and November for sure. Thanks a lot, Ryan. Appreciate it.
Absolutely. Thanks for having me.
We're just getting started here on Market Domination. Coming up, Chicago Fed President Austin Goolsbee signaled in an interview with Yahoo Finance that the central bank is closer to cutting interest rates. Up next, we've got one former Fed president asking why the central bank is telegraphing that move. Plus, shares of Abbott Laboratories sinking today on the back of its latest earnings report. We'll tell you why and check in on some of our other top trending tickers later in the hour. All that and more when Market Domination returns.
The more months of data you get, like the last 7 months of last year, for sure that's what the path to 2% looks like. And that's the golden path, as I called it, that inflation has come down very rapidly. in historic terms without a recession. And that's never really happened before in the US or in almost any of the advanced economies. So let's stick with the program.
Chicago Fed President Austin Goolsbee declining to say when he expects rate cuts in an interview with Yahoo Finance's Jennifer Schonberger. But he did note that keeping policy restrictive could be a risk to inflation's golden path, in his words. He's the latest in a string of Fed officials suggesting we are closer to a cut ahead of the FOMC's July meeting. Joining us now is Thomas Hoenig, former Kansas City Fed president and distinguished senior fellow with the Mercatus Center. Thank you so much for being here. So what do you make of this sort of what now seems to be a drumbeat to a cut, likely in September? At least that's what the market's pricing in.
I've heard the drumbeat before. Late last fall, there was improvement in the inflation numbers. We're all ready to cut. They announced basically they were going to do 3 cuts, and then suddenly inflation picked up, the economy remained strong, and they had to postpone it. And it was, I think, unfortunate because they actually led the economy in terms of their announcements to ease financial conditions, and it had its other effects, raising inflation back. So I think they're perhaps again very anxious to cut rates. I understand that, but if you think about it, the Atlanta Fed just revised its GDP numbers, raising them for second quarter to 2.5%. The labor market is still strong, even though they say it's weakening. It's actually becoming more in equilibrium. We're still adding over 200,000 jobs. The average is still fairly high. And most importantly, while they keep saying inflation is coming down, it has for the last 2 to 3 months. But actually, inflation for the last almost year has run just about on the CPI around 3% consistently, and on the PCE still 2.5 to 2.6%. They're not at 2%. So I think they should be careful, and I think that's why they're not saying when, because they don't want to suggest something that might not happen, but they are leading the market by keep saying we're going to cut, and I think they should be more cautious in their excitement about cutting rates.
You know, Thomas, you mentioned the labor market there. When we have economists on the show, Thomas, who argued they should be cutting, they often do come back that labor backdrop, Thomas, and in part, you know, they're certainly very focused on the unemployment rate rising, but you don't sound concerned about the labor market.
Well, of course, like everyone else, I watch the labor market, but the unemployment rate is still 4.1%, in some sense, very historically low. I think that part of it is very positive. I like it. But the fact of the matter is, inflation's still 3% year over year, 2.6% using their so-called favored measure, which is still not 2%. And they're talking about rate cuts in September. I think that is kind of a getting ahead of the game, if you will, in terms of cuts. I think the labor market is stable. I think labor wages are increasing. That's a good thing. Retail sales were very strong. Those are all very positive things, and they don't suggest that we need to cut. The other thing I keep reminding them is I've seen this before. In the 70s, they bring inflation down a while, and then they quickly cut, and then inflation would reignite. I know they're worried about leaving rates at 5.25 for too long. I understand that, but when you think about those rates, inflation is 3% using the CPI, close to 3% using their other measures, but the rate is 5.25. So real rates are around 2%. That's not exceptionally high in the terms of the long-term run of real policy rates that give you, I think, a stable economy for the long term. And in that environment, it's going to take a while to get their inflation numbers year over year down to 3%. So why not be patient, watch it carefully. When the year over year numbers are clearly coming down and staying down, then they can cut rates. But I don't think they have to anticipate it. And they keep promising the market. That's having its own effects. I mean, right now, the bet is pretty safe. If you invest right now and the only way interest rates are going is down, you have a pretty safe bet. And I think that has its own effects that the Fed should be aware of and taking into account.
You know, we have talked to a lot of folks who say the balance of risks are in waiting too long, not in cutting too soon. I mean, if you talk to folks like Mohammed El-Arian, they talk about that the economic risks, the risks of to the labor market, for example, that those risks are mounting. It sounds like you don't see evidence of that, of the sort of recession risks climbing here.
Well, I can't predict recessions, and it's hard to know, and I understand their dilemma. I was there as to whether they are leaving rates too high too long. But I think if you look at real rates, they're not exceptionally high. 2% is not a particularly high level, number one. Number two, if they ease too soon, they will, I think, risk reigniting inflation, and that is the heavier tax. I think they have room to wait, and why not be cautious? I don't mean to say, I'm not saying raising rates, but they should be very cautious in terms of how quickly they cut, given the strength of the economy. 2.5% growth, a good labor market overall, a good retail sales overall. These are all positive things. A very strong stock market, despite some volatility, very strong stock market. Real wages are increasing. So I want to do the right thing, but I want to do it prudently, and I want to make sure the Fed doesn't have to reverse itself again. And that would be, you talk about a loss of credibility. If they eased and inflation took off, I think they would lose a tremendous amount of credibility in the public and among politicians.
Thomas, quick question here. You saw former President Trump gave an interview to Bloomberg Businessweek, Thomas, and he said the Fed should abstain from cutting rates before the November election. It's something that they know they shouldn't be doing, Trump says. I'm just curious, Thomas, how does the election, if at all, impact if and when the Fed cuts?
I think the Open Market Committee will be trying not to be swayed by political events. They're very careful about that. Now, you can't talk about it over and over again and not hear it. So they have to take that into account. But I think they will do, when it really comes down to it, what they think they should. And I'm hoping, not because Trump is speaking or Biden is speaking or any congressman is speaking, but because they know it's prudent to wait, that they wait beyond September, depending on, of course, if they get a shock, the banking industry gets under significant pressure, they will and should ease rates, at least for a while, to get through the shock, just like they did in March of 2023, but not for political reasons.
Thomas, thank you so much for joining the show today. We appreciate it.
We're glad to be with you, and thanks for having me.
Now let's get to some trending tickers on Yahoo Finance today. First up, Abbott Laboratories. You can see they're down about 4%. Company beating second quarter earnings expectations, raising its 2024 guidance in the process. And joining us with more is Yahoo Finance's very own Anjali Kamlani. Anj.
That's right, Josh. I know you saw a really positive earnings report, but you're seeing that stock down, and it's actually a combination effect. Firstly, some of the concerns for Abbott include a court case going on, going back to that baby formula issue that they had. So that's putting pressure on the stock. And then there's the broader story of healthcare stocks today. Let's sit on Abbott for a second. Really good numbers, increased their general outlook. And importantly enough, I wanted to break out not just beating on both EPS and revenue, but also one really interesting part of it was the glucose monitoring devices. And that's playing a really big role in this GLP-1 boom that we've been watching. They actually saw an increase in the sales of their glucose monitoring devices used by diabetics. And that's been an interesting story to follow, considering what you've seen is sort of doomsday predictions for these types of devices in the wake of greater GLP-1 use and the potential, therefore, to not have to use them. But Abbott has been one of those companies who has said they have continued to see. So they saw 20% year-over-year growth for the quarter, $1.6 billion they brought in for that. So really good story there for Abbott.
Really good story, but the stock is down. And it's not the only one. I mean, as you said, there's this sort of broader healthcare story today where we're seeing Eli Lilly in particular. That stock's been trending all day and it's been lower.
Yes. So it's kind of a confusing thing, but bear with me. So what is happening right now for healthcare, which, by the way, is having its worst day since October of 2022, what's happening is sort of a correction. I spoke to a few folks earlier today, and they're saying that, in general, the stock in particular, Eli Lilly, but also the industry at large, has been growing at a pretty decent clip. And for the last 6 months, it has continued to do that. And so what's happening right now is a bit of a correction on that side. It's falling into this track of not being as defensive a sector as before. And in addition, the Lilly in particular, because of that boom it's been getting from the GLP-1 sales, it's just been going up and up and up. And this, the slight trade down from the Roche news yesterday, that is not the huge drag. It just started a cascading waterfall, if you will, of downfall.
Excuse to sell, perhaps.
Perhaps.
Yeah. All right. Thanks, Anj. Appreciate it. Next up, we're watching Taiwan Semiconductor, and the Taiwanese chip giant did report its second quarter earnings. It posted a beat on EPS, profit rising 36% from a year earlier, raised its 2024 sales outlook to signal confidence in the boom. The chipmaker CEO saying on an earnings call, quote, "This time AI demand is more real than 2 or 3 years ago," and this coming just a day after reports of potentially tighter trade restrictions from the U.S. that, of course, sent chip stocks lower. All of that said, TSM's not recovering today. Those shares are lower now. They have been bouncing around a little bit. They're off their lows of the day right now. But it's really interesting, Josh, that, they're still seeing some selling pressure despite these positive numbers. And not only that, we are seeing a more mixed trade within the chips more broadly. In other words, as we were talking about earlier, NVIDIA's up today.
Yep.
So it's not like you were seeing this sort of wholesale selling like we saw yesterday.
No, it's interesting. I mean, they reported, they beat, they raised their projections for 2024 revenue growth. Companies saying it's likely to meet its gross margin target of 53% or above. So these sound like good headlines. To your point, the stock's slipping here. And it is interesting to see, though, in the chip space where people are deciding they want to put their money today because NVIDIA is working, Broadcom's working, Intel's working.
Yeah, so it's hard to tell exactly what's happening.
Yep.
All right, and our last trading ticker is Blackstone. Shares of the company rising after releasing their second quarter earnings. The firm did miss on profit expectations, but it did increase the pace of its investment activity. Blackstone seeing more than $39 billion in inflows. It deployed nearly $34 billion in the quarter, which is up 70%. From the prior year. And I spoke to Blackstone's president and chief operating officer, Jonathan Gray, and here's what he said about the quarter earlier. Oh, actually, I'll just paraphrase what he told me earlier.
Thankfully, you did the interview, Julie.
I did the interview, so I recall what he said. He talked basically about the fact that even though we have not yet seen the Fed cut rates, that costs of capital have already started to come down. It's kind of what Thomas Honig was just referring to here, because the Fed has telegraphed what it's going to do. Cost of capital started to come down, and Blackstone has decided it's not waiting for that first rate cut. It's going to start deploying capital. How is it deploying it? Well, it's made some acquisitions. It bought something called Air Communities. It's a huge real estate investor. It bought Tropical Smoothies, which is a chain of smoothie stores, as the name would indicate. And it's been investing a lot in its private credit business. Remember, we've talked a little bit about that business before, not just at Blackstone, but at a lot of different companies. It's been a big area of growth in alternative investments over the past couple of years.
And when you chatted to Mr. Gray, did the election happen to come up?
The
Because
election
as
did
Stephen
happen to come
Schwarzman,
up.
co-founder of Blackstone,
Yes.
we know, supports Trump.
Right. Well, Gray is known as a Democratic donor, so they're on different sides of the political spectrum
That
in
must
that
be an
sense.
interesting lunch.
It must be, but he sort of emphasized both in the call and in our discussion that their job running Blackstone is really to keep it on the steady path. I asked him about J.D. Vance's sort of incendiary anti-Wall Street comments last night.
Wall Street Barons, I think, was that?
Yes,
Yeah.
and he didn't really react directly to that. He did seem to think that there would be sort of advantages in either sort of administration, and that they'll just have to navigate it no matter what.
All right.
So-
Which they will.
Which they will. All right, Meta is reportedly in talks to buy a 5% stake in Ray-Ban maker EssilorLuxottica. For more, we're bringing in Yahoo Finance tech editor Dan Howley, the maker of Ray-Bans, teaming up with Meta potentially. What's going on here? Give us the story.
Yeah, Julie, this is being reported by a number of sources. I reached out to Meta and they said no comment, obviously, at this point. But really, this kind of lines up with their plans for essentially mixed reality glasses or augmented reality glasses. Right now, they sell their Meta Ray-Bans through obviously the Essilor Luxottica. They're basically Ray-Bans. They're Wayfarer style Ray-Bans with cameras on either side. You don't get any kind of mixed reality features with them yet. You basically use them as cameras. They do have some built-in artificial intelligence where, you know, the cameras can look at something and you can ask what it is, or you can use them to translate text that they see. But overall, you know, that's essentially where it ends. It's not something like, you know, Star Trek style lenses or anything along those lines, but that's where Meta wants to take this. And since they don't actually own the hardware maker of this, a major product for them, they want to get a stake in that. And that seems to be what's going on here. Of course, they already own previously purchased Oculus, which makes their Meta headset, the Meta Quest headset. So this is kind of a push in the opposite, the kind of side direction of that augmented reality. And, you know, Mark Zuckerberg has said that eventually he just wants these to be regular old glasses that you can slide on, give you information about the world, see augmented reality people who are in other parts of the world as if they are appearing directly before you. And kind of the pitch trailer for why they renamed the company Meta, he showed himself fencing with someone around the world, presumably, while wearing a pair of advanced glasses. And so they continue to work on these kinds of capabilities, but it's not a huge market. I have seen a few people wear them. Granted, I am, you know, in tech circles with fellow dorks. And so that's probably why, although one friend not in tech does have a pair. It is kind of unsettling when you see them. I think for most people, it's kind of weird that there's just people walking around with cameras looking at you, although we do have them on our phones at all times. But yeah, it's not a huge revenue driver for Meta at this point, though. If they're able to kind of make this more enticing, add those mixed reality, augmented reality capabilities, it could be something for them in the future. It's going to take a lot to get the technology, though, in there and get the sizing right, so it's just a pair of glasses and not some bulky headset that you're wearing, like, you know, the Vision Pro or the Meta Quest.
All right, Dan, thank you so much for joining the show. Appreciate it. Shares of Palantir higher today on the back of a bullish call. We'll dive into that note with the analyst behind the note, Dan Ives, on the other side. Stick around. More market domination still to come.
Breaking news now. Broadcom reportedly has been in talks with OpenAI to develop a new chip. And Broadcom shares have been jumping on this news, although right now they're just up about 1%. But if you look at the intraday chart, you see an increase here. This is according to a report in The Information, which says that OpenAI has been hiring former members of a Google unit that produces Google's AI chip, and then has been talking to chip designers like Broadcom about now working on this chip.
Yeah, I mean, Broadcom, listen, if you just look at the stock, it's had this incredible run. And in part, that's because investors have decided that Hock Tan's company is one of the smart ways to just play the mega trend of AI. And the street loves Broadcom as well. I mean, like Bernstein's Stacy Rasgon, friend of the show, one of his favorite names, in part because, again, he just thinks it has one of the best AI stories in the industry.
Right. There's been a lot of talk about various of the so-called hyperscalers developing their own AI chips, and that's sort of materialized into differing degrees. So we'll see if this actually ends up happening.
You could just say words like Sam Altman and OpenAI and probably get a positive response.
That's
People get
probably
very
true.
excited.
Yes, they do. All right. Well, the 2024 presidential election will not actually take place for another 4 months, but the solar sector is already paying close attention since whoever's in the White House could mean major changes. Joining us now is Mahip Mandloy, Mizuho Director of Clean Energy Equity Research. Thanks for being here. And, you know, just to sort of put a fine point on what we've been seeing in this industry, just today we're seeing a plunge in shares of SunPower because it sounds like effectively, it's getting close to going out of business. It's not going to support new installations, not going to have new shipments, even with all of the sort of government support there's been for the industry. So I guess let's start there, Mahip. What is the status, the current status of the solar industry at this point?
Sure, and thanks for having me, Josh and Julie. On this industry, the residential solar industry, which is where SunPower and all the companies listed over here look at, that industry is more impacted by higher interest rates. So the double whammy on that is interest rates obviously make it expensive for the homeowners to buy and finance residential solar roofs for them. But it also makes the credit tighter for the installers. And that's where we've seen a lot of private installers go bankrupt in the last few quarters over here. And the other part of the equation was also that California removed the incentive or reduced the incentive to sell electricity back to the grid for solar homeowners. So I think the California issue probably just corrects itself over time, but I think the interest rate aspect is probably much more important for the sector. We do have, some tailwinds here. The cost of solar panels have gone down, batteries have gone down, but that will probably trickle down over a longer period. I think once interest rates come down, we should definitely see more improvement in this space.
And Mahip, I'm just curious, how does just overall U.S. demand, as it stands right now, sort of compare and contrast to what you're seeing in Europe?
No, that's a good question. So in the U.S. right now, residential solar demand for 2024, if you look at what experts are saying, it's almost down 20% year over year. And this is just solar. If you look at solar plus batteries, it's slightly better. Batteries are more popular now because of prices going down. Europe is slightly different. I don't recall the numbers top of my head, but in Europe, the demand was much higher in 2021 because of the gas power crisis over there. So a lot of folks were installing solar on their roofs. So over there, you have like some slowdown as well, but it's not as acute as we are seeing in the U.S. markets right now.
So Mahip, now let's take a theoretical situation where former President Trump wins re-election. What then happens to this industry, and how are they preparing for it?
That's a great question. That's not something a lot of investors have been asking us ever since early this year, but the call volume has definitely increased in the last few weeks over here. The one thing, or rather, the Trump team or the GOP has not yet released a detailed platform or detailed points on what they want to do. So I'm just thinking of how the President Biden's team 5 years ago came out with their detailed plan for Build Back Better. We haven't seen that yet. But absent that, the one thing we've definitely seen is they want to, as in the Republicans do want to scale back or repeal the Inflation Reduction Act and potentially impose tariffs on China and imports from other countries. So these two will be the biggest things. We did some work around it, and we saw generally these two policies together could reduce demand or valuation for the solar space by around 20 to 30% later this year.
Mahip, thanks so much for joining the show today. Appreciate it.
Thanks for having me.
Let's get to some calls of the day now. Wedbush out with a new bullish call for Palantir, raising its bull case price target on the stock to $50 for 2025. Note saying that the Messi of AI is in a prime spot for the AI revolution. For more, we are now bringing in the analyst behind that note, Dan Ives, Senior Equity Analyst at Wedbush. Dan, it is good to see you. So this note, Dan, you maintain the outperform. The target's 35, but the new bull case is 50 for 2025. Walk us through that note, Dan. How come?
Yeah, Josh, the AI revolution's here. And when I look at the next step, the use cases, Palantir, I think, is going to really be the one that's front and center in a lot of these deals. And we're seeing that through a lot of these cloud channels, a lot of the work we do in boot camps. Investors, look, if you've seen, they're negative at 6, they hate it at 12, despise it at 18, and screaming at 25. And I think that this is a stock that has a massive move ahead of it, given where the AI revolution's heading. And that's why it's the Messi of AI.
I was curious, Dan, reading your note, what had changed or what different information that you had to take you to that bull case? Because it looks similar to the case that you had made before for the stock. So was there more data that you were gathering to get you to 50 here?
Yeah, Julie, it's just in the almost 100 customers that we've spoke with, the conviction level is increasing. I think deals accelerating. And I think what we're seeing on AIP conversion is even stronger than we expected. Now, does that mean for this quarter, for next quarter? But when I look out the next 6, 12 months on Palantir, I think this is going to be a golden child of AI. And right now, I mean, institutionally speaking, it's very negative because I think many don't understand or appreciate the true, what I view as the competitive moat that Karp and Palantir built.
It was interesting, Dan. I was talking not too long ago with Brent Till over at Jefferies and covers Palantir, and he was encouraged by what he saw in Palantir's business and fundamentals, but he was staying on the sidelines, and it was a valuation call. He just thought it looked pricey, but you don't share those concerns here.
Josh, I get the valuation argument, but it's very similar to how I viewed Microsoft and Apple and Tesla and so many other names, that you have to view it as a sum of the parts. You got to view it on what's the commercial business worth, what is AIP going to drive, and then put some multiple in the government business. And I think when you start to put those together, I mean, you could start, 35 is our base case, but then you start to get to a bull case $50 into next year. As this goes to the second, third, fourth derivative. And I don't know how you could have a basket of AI stocks and just dismiss Palantir. I mean, that's sort of our view, and that's been our conversations with investors, even though it's a very contentious name.
Dan, I'm sure you're aware of some of the chatter, you kind of referred to it, that's out there lately. There is some skepticism creeping out there on AI. Edison Lee over at Jefferies just writing today that what we're seeing right now in tech in terms of the sell-off isn't actually about geopolitics. It's not actually about concern over China and Taiwan. It's actually about concern over AI's return on investment. I know you don't agree with that, clearly. But, are people, what do you think that's about? Is it just that people are getting impatient here? What do you think? Or do you think that they have a point?
I mean, look, this sell-off, I can tell you from all my conversations the last 48 hours, it's the Trump, Taiwan, China war, right? I mean, those comments, and obviously he'll speak tonight, and then you factor in a potential Trump second term. What does that mean in terms of the AI trade? So I think That's this sell-off. But Julie, I think when me, you, and Josh talk in the next few weeks, and Josh is wearing his pink sports jacket, I think we're going to have a massive tech earnings season for tech, for semis, for software that changes the narrative. But I always say, I mean, you can see AI on your spreadsheets or in the 10th floor of your New York City office building. And I think that's why we spend so much time around the globe, and there is no denying this AI revolution is probably the biggest tech trend we've seen in the last 40, 50 years.
Switching gears here, Dan, another name you cover. I want to get your take on Apple, because we did have, well-known analyst Ming-Chi Kuo was writing today that there's been these rumors of increased orders for iPhone 16 from time to time. But looking at recent earnings calls from some Apple suppliers saying, hinting that the iPhone 16 orders may not have increased. Where are you on Apple as we head into that earnings print as well, Dan?
Yeah, Josh, many yell fire in the crowd theater on Apple. 160, 170. So I get it. At 230, people are going to double down those calls. I mean, all of our checks show rising demand for iPhone 16. The AI story is coming to Cupertino. And I think a lot of investors have been caught off sides on this one. And I think a year from now, we have a $4 trillion market cap. But again, I get the skepticism. A lot of haters in Apple at 150, 160, and at 230, they really hate it.
Dan, good to see you. We'll rejoin you soon with the pink jacket on my esteemed co-anchor.
I could see Lipton wearing that pink or purple sports shirt.
No, I want that shirt, Dan. I want that shirt. That's what I want for Apple Day.
I'm bringing it to you in July.
I know I can count on you.
I'm so excited about this. Thank you, Dan. Stay tuned. More market domination on the other side.
Welcome to Stocks in Translation.
I'm almost always of the school that you buy high, sell higher.
Our essential conversation cutting through the hyperboles.
When the horse gets out of the barn, you have to go chase it.
The market mayhem.
Are you bullish or are you bearish? What is your target?
And the noisy numbers.
Don't fight Papa Dow.
Time now for our word of the day. This episode happens to be brought to us by the number 2. Eddie, who is wearing the DeFi mantra better? Is it Solana or Cardano? To give you the information you need for your portfolio.
There are a lot of ways to invest where you don't have to extend yourself and try to hit that home run.
You're going to find that technology was a leader and an outperformer in pretty much every single one of them.
Do we get the follow-on participation?
That's the big question, and maybe Jay Powell will help us with the little rate cut.
Watch Stocks in Translation here on Yahoo Finance at noon on Tuesdays and Thursdays, and listen to us on Apple, Spotify, iHeartRadio, or wherever you get your podcasts.
Wall Street facing increasing turbulence this week, particularly with big cap tech stocks. The Nasdaq sliding again after its worst day since 2022, marking a continuation of the shift away from tech. With this move out of tech shares, does it leave an opportunity on the table, maybe worth taking for investors? We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Spear Invest founder and CIO Ivana Delevska joins us now. She is a tech investor. So Ivana, as we are seeing this pullback here, does it make sense for people to add to positions? And if so, how should they be thinking about doing that?
Thanks for having me, Julie. So we do still see a lot of opportunities in the data center value chain. And I think it makes a lot of sense to add to that on this pullback. This has been a pretty meaningful pullback on what is a headline risk, right, that you always have in the sector. And the stocks are down more than 10% from the levels. So I think it's a very good time for investors to take a look at the data center value chain.
And when you say data center value chain, Ivana, what name specifically are you talking about?
So the core of the data center value chains would be opportunities inside the rack. So would be processors like NVIDIA, AMD. But then the opportunity is broader than that, right? It's basically the entire infrastructure build out around data centers. So there's opportunities in thermal management, power management, even at the utilities level, because energy is one of the big constraints that we see. So it's really going to be across the board.
Ivana, earlier today I talked to the Blackstone president and chief operating officer, Jonathan Gray. Blackstone, a huge investor in data centers. And I asked him sort of how he's thinking about a little bit of the skepticism that's been out there right now. And he talked to me about that investment. Listen to what he had to say.
We think there are going to be a lot of changes. Some of that may take a bit of time. But our focus has really been on building the backbone, the infrastructure of the 21st century, which is the data centers and the power that goes with it. I think this will come. What the profitability will be, which applications will win, I think that is uncertain. But I think the path here towards more AI, more compute power, and therefore more infrastructure needed is the way to go.
So you were just talking about the infrastructure as well, but it does seem like at least some of this sell-off, while yes, it was spurred by concerns over China, also has to do with real questions about not the infrastructure, but like what you do with it, right? The software, the end users. How are you thinking about those questions?
That's right, Julie. So that's really the main question here is, are there end applications that are useful, that are justifying all of this investment that is going in place? And seemingly, if you look at what's come out, apart from ChatGPT, at first sight, there doesn't seem to be a ton of large multi-billion-dollar applications. But what I think the market is missing is that some of the early investors like Meta, like Google, they're investing significant dollars into this. They're doing it to defend their current business, right? So if Google doesn't keep up with ChatGPT, their entire business is under attack. Similar with Meta, they were able to really do a good job with Reels and Instagram and reinvigorate their business. So just these two applications of recommenders are just huge investment and require significant investment going forward to keep up with it. And then as we go forward, it's going to take 2 to 3 years to see real applications come through. We are already seeing it on the early side with customer service and productivity improvement tools that are really leveraging the large language models. But the next level, the next layer of opportunity will be in the physical, like robotics, autonomous driving, and that's going to take a little bit longer to play out. Nevertheless, you do need to make the investments today in compute to be able to advance these applications even a little bit.
Ivana, another space I know you monitor closely is the cybersecurity sector, Ivana. I'm interested in what names you like here at these levels. And also in that same theme, Ivana, any thoughts on these reports we're seeing of a potential Alphabet Wiz deal?
Yeah, absolutely. We really like the cybersecurity space. I think it got caught in the software sell-off, while the fundamentals for cybersecurity are significantly improving. So we're seeing a lot of opportunities there today. We like Zscaler, we like Datadog, we like many companies, and we disclose our holdings on our website just for your viewers. On the Wiz on the Wiz deal, I think it would, at first sight, it looked like a low probability deal, but the more we dug into it, it makes a lot of strategic sense for Google. Even though Wiz is one of those companies, they're very rapidly growing. They just raised their new round. It didn't seem like they would need to be doing an acquisition or they would need to sell themselves. But the more we looked into it, it does seem like a very good strategic fit. The price tag that they're paying is pretty significant and has pretty positive implications for the rest of cybersecurity, both for the companies that are next-gen leaders with similar growth profiles to Wiz, as well as smaller cap players like SentinelOne, for example, that is in that same boat, very high growth, but hasn't been able to really get a good valuation in the public markets.
Ivana, always great to have you on the show. Thanks for joining us. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings report from Netflix. Stay tuned.
That's the closing bell on Wall Street. And now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. First, let's talk briefly about where the major averages ended the day, because we did have a tumble for all three major averages here, ending the day lower after a mixed picture as of late. There you have them. We got the Dow down by 533 points, the S&P off about 0.75, and the Nasdaq down 0.7. Jared's got a closer look at the sector action right now.
That's right. And, you know, finally, the Dow and the Nasdaq are moving in the same direction. Unfortunately, it's down. You can see the Dow off, as you said, Julie, 500 points plus. Also check in on the Russell 2000. We were in the midst of a great stretch, but yesterday kind of trailed off at the end of the day, continued on into into today, or actually yesterday was down quite a bit, continued into today. And also taking a look at the VIX. Now, with the worst day for the Nasdaq in a couple of years yesterday, we do see the VIX a bit higher. We can see it's been trending higher over the last few days. It's up to 16, and that's not a high amount, but you can see it is the highest amount that we've had in a couple months. So that's definitely something we want to keep track of going forward. We can also take a look at bond index volatility. That's somewhat subdued. That's called the MOVE index right here. And then the 10-year T-note yield. We can see that's up about 4 basis points today, although the direction has been down for the most part over the last several months. Finally, also want to show that the US dollar index was up today, but it has also been down over the last month or so. Now, let's get into some heat map action with the sectors. We can see only energy, XLE in the green, finishing the day up 20 basis points, but it was healthcare that really took it on the chin. Financials and consumer discretionary and materials also down by 1%. And I wanted to check in on what's happening in the pharma sector. Wasn't able to find any big news, any headline, any catalyst, except Eli Lilly. We saw a bit of technical selling, that's what I'm going to call it, kind of fell off, and then you can imagine a bunch of stops getting hit. It ended the day precisely at its 50-day moving average, not shown here, so that's why I'm calling that technical selling. But other than that, pretty red day. Guys?
Thanks so much, Jared. And we've got some breaking news right now. That is Netflix earnings. Let's run through the major numbers here. Second quarter earnings per share, $4.88. The company had a second quarter 17% revenue growth here to $9.56 billion. Both of those numbers ahead of analyst estimates. But let's pay attention to what they're saying both about memberships as well as what's happening in the third quarter. Second quarter streaming paid memberships, 277.65 million. That is ahead of estimates. Remember, Netflix isn't going to be reporting those numbers for much longer. But the company says in the third quarter, those additions will be lower than a year ago. The company also says third quarter revenue will be $9.73 billion. That is below what analysts had been anticipating. The second quarter streaming numbers looked stronger than estimated, but it looks like that forecast is what's driving those shares down in the after-hours session here. So interesting to see that. One more thing to mention when we're talking about forecasts, for the full year, Netflix says revenue growth will be 14 to 15%. So what they did basically was bring up the lower end of that range by a percentage point. It had been 13 to 15%, but that doesn't mitigate, at least not initially here, Josh, the selling that we are seeing.
Yeah, and especially, you think about the stock, Julie, had such a nice, strong run into the print. I mean, expectations were elevated to begin with, and when you have a run like that, a kind of mixed guide is not going to get it done, and at least that's what it looks like. Q3 EPS, the guidance of 510, that's a beat, right? The street was at 474, but to your point, the revenue here of 9.73, that's a miss. Street was at 9.83. It also looks like their free cash flow for the year, they're looking for about $6 billion. Estimates were closer to about 6.6.
Yeah, a couple of other things to mention here. The company is talking about their ads business, and they said they're making steady progress scaling that business. Ad tier membership growing 34% quarter over quarter. So that's something to pay attention to. Also, when we talk about the third quarter forecast that the company is giving, as they point out, the third quarter last year was the first full quarter that they had the paid sharing changes that they had been making. So tough comps, in other words, when you're looking at that last year third quarter. So that's something to keep in mind here. I'm continuing to go through the letter to shareholders, but that stood out to me.
All right. Well, we join us here for a closer look now at Netflix's second quarter. We have Jamie Lumley, Third Bridge Group sector analyst. Right, Jamie. So at least initially here, investors seem a bit disappointed in the after hours, but what's your initial reaction to the print? What do you make of it?
Well, going into these earnings, expectations were super high. If we look at the last year for Netflix, it has continued to over-deliver on basically all of its core metrics. If we look at operating margin, we look at that subscriber growth, there's definitely a history of really knocking it out of the park here. So first thoughts on this, certainly subscriber growth continues to be very healthy. That $8 million subscriber number is well above what most analysts were expecting. Most expectations were in that 5 to 6 range. And this is a good indication of both the ad-supported tier continuing to gain traction, and also the fact that there is room left to run when it comes to growth from that crackdown on password sharing. The bigger questions, though, are, of course, looking out longer term. If we think about the rest of this runway for the crackdown on password sharing, how long is that road? We only have a couple more quarters of getting these numbers on subscriber totals. So investors may be a little bit anxious thinking about how much growth there really is left for that audience base.
So how are you thinking about those questions, and how are you thinking about how your modeling for the company is going to change as they stop reporting that streaming number?
So certainly the way that Netflix has been talking about this is the fact that they're no longer looking just at subscriber numbers as the best way to model their growth story. And they have other metrics which are quite important. Operating margin really jumps out here, as that's really, if we think about the rest of the landscape.
Which was 27% last quarter.
Yeah, 27% down from 28%, but above the guidance of 26 and change. So certainly continues to be quite strong. And this is where they can really flex their muscle against the rest of the competition. Disney's targeting double digits long term. That's just over 10. And Netflix is not only there, continues to really be head and shoulders above this. So although we can't necessarily look at just the traditional math of subscribers and ARPU, we can continue to really see what the effect of Netflix's initiatives are, how they're thinking about their expenses in addition to their growth, to really see where the strength of the company could be.
And Jamie, what about the ad business? How do you see it evolving from here? How bullish are you on that?
So the ad business is quite interesting because initially Netflix had some pretty aggressive goals. They were targeting 40 million subscribers by the third quarter of last year. They only hit that target back in May of this year. It does continue to take up a significant part of their growth story for a subscriber standpoint, but it has yet to really prove itself. So there are definitely levers which can continue to be growth with this business. We've heard from our experts that there's still a lot of flexibility for driving up CPMs, raising that ad load, tailoring the ad experience to different users. But this business still really needs to get some work done before it generates substantial revenue. What we've been hearing is that really Amazon is a big player here when it comes to ads and streaming. They're the player which is disrupting the market, really impacting ad sales. Those CPMs you're seeing out there right now. So as things stand, Netflix still has a bit of work to do on that ad tier.
I want to ask about content because the company, talking about Bridgerton, of course, its big hit in the second quarter. That's one of the things that seems to have helped their numbers. They talk in the letter today about the Bridgerton universe, as they call it, generating 172 million views. When you look at the third quarter and what looks like a disappointing forecast for subscriber growth, is it because there isn't, Bridgerton's done? Like, what's the next thing? That's what you always want to know with these streaming services. What's the next big piece of content that's going to generate excitement?
It's a really good point, and that's the big question for all the streaming businesses all the time. What's as good as your last hit was? What is next? And that's something the creatives will continually work on, especially remembering that we're in an interesting time period. We're coming out of that strike period in Hollywood last year, which really disrupted the content slates, the distribution of various types of content, and has made this year be a little bit chunky in terms of what's coming out when and what's really in that pipeline. Going forward, the summer is usually also a softer month. You think about demands on people's times. People are spending more time outside. Their leisure time is spent in different activities. That's where Netflix is really thinking about competing with all use of leisure time, not just the other streaming platforms. But their content is interesting. We've seen some marquee deals that they've made over the last few months. We have NFL games coming up at Christmas. We have WWE starting next fall, in addition to the ongoing pipeline of originals. So Netflix is definitely trying to diversify their content strategy, find new ways to engage with people, be it finding the next Bridgerton or finding routine programming to continue to have people come back again and again. But they're still trying to figure out what exactly the right balance is for their types of content they want to bring to people.
And we should note, Jamie, the stock now, off its lows here, it's down about 2%. I want to ask you a question about sports as well, and how you think Netflix is thinking about sports. And do you think you need, Jamie, do you need more sports if you're going to really build a strong, durable ad business?
It's a really good question because advertisers love sports. This is one of the areas which drives steady engagement from viewers. It drives very strong CPMs, and it's something which is really helpful for getting that ad business off the ground. The flip side of this, of course, is the fact that sports are incredibly expensive. We're currently in the process of seeing just how expensive the NBA rights are, with that $76 billion deal being finalized, or in the process being finalized right now with various distribution partners. Whether Netflix truly wants to compete in that space is an open question. They've dabbled a little bit. They have their live sports entertainment. They've one-off different events, such as the various golf tournaments they've had. It seems right now they're figuring out just how much they want to spend on this. They do like live. The management has talked talked about live extensively, but it does seem unlikely that, at least in the short term, they'll really be investing in some of those marquee, massive sports properties.
As Josh just pointed out, the shares are not down as much as they were earlier. There was an interesting note out from Bespoke Investment Research earlier that talked about how much Netflix tends to move versus other companies in reaction to earnings. So by that metric, the 2.1% looks even smaller, I guess, in terms of a drop. I know you don't give investment recommendations on stocks per se, but for lack of a better way of putting it, would you be a buyer of Netflix here? I mean, should investors be looking at this as well-positioned in the streaming universe?
So here's how I think about this and what we're hearing from the experts we speak with. So basically, Netflix continues to be at the forefront of the streaming landscape. They have the largest audience. They have a really healthy flow of content. One thing which is really interesting is the fact that last year, in the midst of the strikes, when they pulled back on content spend, they didn't see subscriber churn escalate materially. They continue to have a really strong position in the mind share of consumers. They are that go-to spot for consumers for entertainment, and continue to be at the top of the list really positions them well as they right-size their content spend and figure out what their content mix is and find new ways to engage consumers. So if we think about the growth story from here, there's still definitely opportunity to continue to drive revenue growth. They have some softer expectations for the summer, highlighting the challenging compare period if you think back to summer 2023, but there are still growth drivers at play here. Ads could definitely continue to scale. And as they get larger and larger, that gives them the ability to really ramp up the price of their ad inventory. And then also we think about the crackdown on password sharing. There's still opportunity there. They talked about 100 million households which were sharing passwords. Over the last year, they've now added about 45 million households. There could still be, ample people who have not paid for Netflix who could still be brought into the fray.
All right, Jamie, thanks a lot. Just want to mention as well, flagging here amongst the other things that Netflix is talking about, it's going to phase out the basic plan that they have in the UK and Canada. I guess they've been doing that, and they're now going to start doing that in the US and in France, and that has helped their ads member base in the second quarter. So going to keep watching that trend as well. Thanks, Jamie. All right, mortgage rates on the decline for a second week. However, homebuyers still hesitant to get in the market. Yahoo Finance's Danny Romero joins us now with more.
Julie, mortgage rates are headed in the right direction, and this is really a positive development for the housing market. Freddie Mac reported that the average 30-year fixed mortgage rate fell to 6.77% from 6.89% from the week prior. This is the lowest level since mid-March. But despite lower rates, home buyers just seem really unimpressed by this. Mortgage Bankers Association reported that applications for a mortgage to purchase a home fell 3% for the week, that on a seasonally adjusted basis. Now, home buyers are not responding to these lower rates, and economists say that this is really not uncommon. When rates come down, demand also weakens too. So this paradox really is driven by buyers making sure that rates don't decline even further before they jump into the housing market. Now, on the other side, homeowners are taking advantage of these lower rates. Mortgage Bankers Association reported that applications for refinancing on a home loan jumped 15% last week. That is the highest level since August of 2022.
And Danny, sticking in the housing space, home builder D.R. Horton reporting. What can you tell us about those results?
Josh, D.R. Horton beat earnings per share estimates, and announced a share buybacks. The stock hit an intraday high this morning, but some of those gains obviously pulled back this afternoon. Some key takeaways, though, from this third quarter earnings call was that builders are actually struggling to sell new homes. D.R. Horton reported that their cancellation rate jumped 18% for the quarter. Now, that is a little bit higher from the 15% last year. So really signaling that buyers are saying no go to the deal. They're walking away from the home completely. Now, some builders have tried to mitigate some of these risks by offering incentives, the mortgage rate buy downs. That's been a popular one. That's when the builder upfronts the cost to lower the rate on the loan. And executives at D.R. Horton said that 77% of their customers have a permanent mortgage rate buy down. And that really stood out to me and really signals that this incentive will not be going away. Looking ahead, though, D.R. Horton did boost its sales expectations for the year. They're expecting a range of 90,000 homes to 90,500 homes, and that is slightly up from their prior guidance of 89,000 homes to 91,000 homes. Josh.
Danny, I'll take it. Thanks so much. Appreciate it. Coming up, what the Supreme Court ruling on the Chevron doctrine could mean for the energy sector and beyond. More market domination over time coming up.
Last month, the Supreme Court stripped power from federal agencies in a 6-3 decision that overturned a decades-old legal standard known as the Chevron doctrine. The ruling is expected to impact dozens of industries that are subject to federal regulation. But let's first take a step back to understand the Chevron doctrine and how its end will change the power of the executive branch. Here with more is our senior legal reporter, Alexis Keenan. Alexis.
Hi, yeah. So this is a 1984 decision, Chevron is. So what it said is where a law is ambiguous, where there's gray area, that Congress has not clarified that gray area, then courts must defer to federal agencies' interpretation of the law. So in June, when the Supreme Court overturned this longstanding precedent, it sent 2 cases back to the lower courts and said, you must read these laws without giving deference to federal agencies. Now, in this case, it was the Department of Commerce that was overseeing commercial fisheries and telling 2 different fisheries, these are 2 that brought the lawsuit, to say that they had to pay for federally mandated monitors on board the ships. They said, no, that is not how the law is stated. And so this is how the court case actually made its way through the system. Now, the effect of this decision is expected to will shift power away from the federal agencies that they've held on to that 40 years. It's going to go back to the courts so that judges now are going to be considering these gray areas, these alleged discrepancies in the laws. Now, critics, they'll say that it's the federal agencies. They're the ones who are the subject matter experts. They're the ones who should be sorting out these gray areas. On the other hand, you have proponents who say that the ruling is already preventing overreach by agencies. The Department of Education is one big one. They have a proposed rule where they want to go into that 1972 civil rights law that's known as Title IX and change the interpretation of the word sex to mean gender identity. So that has been a big one, to say that the Chevron decision is going to really impact things like this, where an agency, or in this case, the executive branch here, is going in and wanting to, under the Department of Education in this case, wanting to make those changes. And though that, of course, has implications, as you can imagine, for biological males, for example, joining female sports or vice versa, using bathrooms dedicated to those genders. There's also another case that is dealing with the Labor Department's rule that says when companies are sorting out 401k plans, that ESG can be a deciding factor, sort of a tiebreaker when they're up in the air about which way to go with a certain investment choice.
A lot of implications, in other words, from all of this.
It's huge. Across industries, it's going to be very impactful.
Most definitely. Thanks, Alexis. Appreciate it. Well, we're going to keep talking about this right now because the Supreme Court Chevron decision is just the most recent in a string of rulings that have redefined agency oversight and administrative law. Here to discuss further is Fred Wagner, partner at Venable LLP, focusing on environmental issues with infrastructure, mining, and energy project development. Thank you for being here. Obviously, I know this is a big topic, and as we were just talking about with Alexis, a lot of potential implications. But at a very high level, how do you view not just the Chevron decision, but some of the other rulings recently? What is the overall effect?
Right. There's been an absolute trend to give less power and less authority to administrative agencies, and to give more authority to the judicial branch to oversee actions from those agencies. So in addition to losing the Chevron deference principle and allowing judges to decide in the first instance whether an agency has interpreted the laws properly, there was another ruling that expanded the statute of limitations, allowing parties to go back to regulations that have been on the books for years to bring litigation challenging those rules if they believe they've been harmed by those rules. And this is also has to be read in conjunction with the major questions doctrine case from a couple of years ago, which said that agencies shouldn't even be regulating in the first place on matters of severe importance to the country and to the economy, when it should be Congress in the first instance telling the agencies what to do. So I read these most recent rulings as of a piece, as a total trend of the last few years, telling federal agencies that their power may have gotten a little bit too strong and that the courts and Congress have a better role. In other words, it's a reorientation of the authority of the three branches of government.
Fred, as you noted there, Congress does assume, I guess, a higher burden here, and the idea would be Congress gets to work, writes more clearly, more explicitly. How confident are you that's how it actually plays out, Fred?
Not. Yeah, I mean, let's be honest. In many instances, in a lot of industries, Congress not only has not been legislating, but when they do legislate, they've gotten into the habit of legislating in a way that actually builds in deference to the federal agencies. They tell the agencies, thou shalt regulate. Within 180 days, thou shalt regulations on whatever the topic is of the legislation, because Congress has been aware of its own limitations, which is that they're not the experts in any particular field. But what I think this means, Josh, is that the role of lobbying Congress is now going to be even more important. Because I think soon people are going to realize that if Congress is so inclined to legislate, that they need more help. They need more help to write things in a way that gives clear direction so that subsequently actions taken by the federal agencies aren't subject to challenge and aren't being subject to overturn. Because that could equally be bad for Congress because their own intent may not be fulfilled unless they're crystal clear. So that's going to take some re-education. That's going to take a lot of staff work a lot of coordination between industry sectors working with staff and traditional technical assistance. And ironically, also more work with the federal agencies, because oftentimes, as you know, congressional staffers are picking up the phone and calling those federal agencies saying, if we write the legislation this way, how will it work? You know, they're asking those questions. And I think the need for that is going to be heightened.
Imagine that, asking the people who know more than you about something, Fred. That's what we do all day long. So let's drill down on what it means for your sort of areas of expertise in terms of sort of environmental law, infrastructure, energy. Can you give us some specific examples about what you're expecting next?
Yes, I think some of it has been, previewed already. There's been any number of cases brought challenging the current administration's rules regarding climate change and regarding the regulation of greenhouse gas emissions. This has taken root in like the SEC disclosure rule for GHG emissions, in the power plant rule, in the vehicle emissions rule. All these rules have already been challenged. There's already litigation pending. Now you can expect the litigation there to be amended to reflect, hey, court, we'd like you now to apply the Loper principle because the Chevron principle is dead. And in general, if there's only two choices, defending a case being easier and harder, this makes the federal government's job harder to defend those cases. Because in many instances, the principle of climate change, the principle of carbon emissions isn't clearly articulated in the Clean Air Act or any other environmental laws for that matter. And so the challenges take on greater weight for a court to say, hey, EPA, how precisely were you addressing this? Where in your statute are you relying? Hey, SEC, when you're saying this is important for disclosures, where particularly are you relying in your statutory authority? And that's going to make the burden, I think, even higher for the agencies to defend these cases in areas where it's not so express in the underlying statutes. And that just doesn't apply in my field, of course. It applies in other important areas dealing with artificial intelligence and all the rest, things that Congress hasn't written about, or maybe Congress hasn't even anticipated. So it just makes the burden on the agencies a little bit harder in court.
It's a big, complicated issue, Fred. Thank you so much for taking the time to walk us through it.
Thank you.
Time now to watch Friday, July 19th. Starting off on the Fed. We're going to get some Fed commentary tomorrow from Fed Presidents John Williams and Raphael Bostic. It's coming after Yahoo Finance's Jennifer Schonberger talked to Chicago Fed President Austin Goolsbee earlier today. Goolsbee saying the central bank is closer to cutting interest rates, but also warning that it risks a recession if officials wait too long to ease monetary policy.
Moving over to earnings, we'll get more from banks. We'll hear from American Express, Huntington Bancshares, and Comerica. Dow Component and American Express announcing second quarter results before the bell. The stock has been having a strong first half, but analysts expect rising credit card costs to remain a potential threat to earnings per share growth. And other corporate results we're expecting tomorrow include Schlumberger, Halliburton, and AutoNation.
That's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Ask Me for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Another steady day of tech declines weighed on major indices, but the fall extends beyond just the one part of the market. The healthcare sector was in fact the worst performer in the S&P 500, with shares of Eli Lilly continuing Wednesday's decline. Plus, ushering in the new era of Republican leadership, Trump's running mate, J.D. Vance, took the RNC stage last night, laying out an economic philosophy that differs sharply from the conservative establishment. We're going to have more on what his ascent could mean for party policy. And the value wars march on. Domino's CEO today saying Americans are still searching for value after the pizza giant forecasted slower comparable sales in its upcoming third quarter. We're diving deeper into the value trend with Placer AI later this hour. Ohio Senator and now the Republican candidate for Vice President J.D. Vance speaking last night at the Republican National Convention, striking a populist tone, which he is known for, but it's a stark contrast to some of the traditional economic policies the Republican Party is well known for. And joining me now is Neil Irwin, Axios chief economics correspondent. Neil, it's great to see you, and it's perfectly timed, Neil, because I think today a lot of traders, investors, business people, Neil, who are watching this, they're trying to make sense, Neil, of what a Trump-Vance White House would mean in terms of economic policies, because you would traditionally, as a Republican administration, Neil, of course you'd think low taxes, less regulation, business friendly. But then you heard Senator Vance last night, Neil, that wasn't so friendly. That was pretty tough on business, tough on multinationals, tough on Wall Street. What are we to make of it all, Neil?
Yeah, he's been at kind of the front edge of a shift within the Republican Party that has traditionally, of course, been the party of business, has been the party of business interests, and has wanted to, cut the corporate income tax rate, has wanted to encourage kind of pro-growth tax policy. And of course, there's plenty of overlap between the Vance worldview and that more traditional Republican worldview. Deregulation, those areas, they're very much aligned. But when it comes down to it, what Vance emphasizes is trying to get wages up for workers and trying to put in place tariff barriers that can really help workers potentially in his argument, but not necessarily be good for businesses that have to import. So, you can see some areas where there are real fault lines that might emerge. And look, I talk to CEOs all the time. A lot of them are not very happy with the Biden administration. They see the approach as being overregulated, but they do have some risk if the Trump-Vance administration comes to be, that they will have some real problems to deal with as they deal with that incoming administration.
It's interesting, Neil, though, because, if Trump-Vance ticket, if this really takes the White House, Trump's the president. Trump sets the economic policy. I mean, do we have any line of sight into how much former President Trump agrees with Senator Vance on some of his perspective and vision when he's talking about business and multinationals and Wall Street, Neil?
Yeah, look, Trump kind of has it all ways. He likes to talk about some of these same populist ideas of focusing on restricting immigration, deportations, tariffs. Obviously, those are core to his political identity. But he also loves talking to CEOs and loves talking about how he's so great for business. He just floated cutting the corporate income tax rate again. He cut it from, I believe, 38% to 21% when he was in office. He wants to go down to 15 now, he says. So, look, there's a lot of things Trump would like to do that are certainly business priorities and things that big business would like to see. And Vance, as vice president, would just be one voice at the table kind of trying to shape those policies. That said, if you think about how parties usually evolve, the sitting vice president, and again, we're in a scenario where Trump-Vance wins in November, is the front runner to be the next nominee. So you can imagine that this is part of a shift in kind of who the Republican base is and what Republican Party priorities are.
I find, Neil, just the shift that we're watching, I think it's just fascinating. And when you listen to these sort of, I guess, populist conservatives, Neil, like Senator Vance, are there areas where in economic policy they can almost, in some sense, overlap with more left of center economic views and policies?
Oh, definitely. Yeah, I think a lot of what you hear from Senator Vance around workers and wages and trying to encourage, for example, trying to encourage productivity gains by having higher wages and labor scarcity. That's a concept that I first heard, years ago from left of center economists. Now something that Vance talked about in an interview with the New York Times last month. So, I think there is a kind of changing of the guard of where parties line up on different issues. And it also intersects with these culture war issues where, Senator Vance views attacking big companies for their diversity initiatives, for example, as a winner for him. It's hard to disentangle what economic policy would look like and some of the culture war stuff that really is part of the Republican Party going after big business.
Such a big, complicated, interesting topic, Neil. Thank you so much for taking the time to walk us through it. Appreciate it.
Thanks, Josh.
The Nasdaq closing the trading day lower as investors exit tech stocks, while the Dow falls more than 500 points in today's trade. With more on the trading day takeaways, we have Yahoo Finance's very own Josh Schaefer. Josh.
Yeah, Josh, we're going to start with the economy first. We had weekly jobless claims out this morning at 8:30, and they came in higher than expected, hitting the highest level since last August, tying a report from earlier in June to hit that 243,000 number. You can see here the big uptick that we had this week, and kind of a couple takeaways from this chart. One being clearly, you can see the trend has been higher, right, over the last couple weeks and really the last couple months. That's what has some economists concerned about what's going on in the labor market, saying, okay, this is fine for now, but if this keeps happening, it's going to be a problem for the Fed. And it's one of the things people are listing as kind of the reason to cut, whether it be July or September. But you can also see, because we have a nice long-term chart here, jobless claims usually go up in the summer. It's called seasonality, right? And they come up a lot in the summer. Part of the reason they rose last week, some economists suspected, was the recent hurricane we had that displaces workers, then they might file for unemployment benefits. So it seemed like a report where you can take a little bit into the, okay, I can see why we're talking about the labor market softening, but also not to panic. And I think that's sort of an important thing to point out here with the chart as well.
Yeah, it's so interesting, Josh, because you're right. We've had so many economists come on the show, and they look at the labor backdrop and it gets them kind of nervous. They see reasons concern. Then again, we just had Thomas Honig on the show, like former Kansas City Fed president, and we asked him about the labor market. He was not concerned, says unemployment rate still historically low. He looks at the labor force right now, says it's stable.
Yeah, there's a couple different ways to slice the pie, right? And it seems interesting. I think going forward, the question is just how much more does it keep going up, right? Yes, it's fine now, but that unemployment rate is ticking up. And I think economists mainly just want to see the Fed cut before it gets too loose. That seems to be sort of the point that we're at thus far. Have to talk about healthcare. Healthcare did not have a good day in the stock market today, Josh. So let's take a look at it. Let's look at the sectors first. You'll see healthcare here falling more than 2%. Remember, this was a sector we talked about the last couple of days that was getting a little bit of a catch-up trade. Healthcare hasn't been a great performer in the S&P 500 over the last couple of years, but really the big driver was Eli Lilly. So I want to get to that stock because I think it's telling us maybe a little bit about the Lilly story, but probably a larger thing about the market right now. Eli Lilly, if we look over the last year, it's the GLP-1 trade, right? It's been a theme.
Move, yeah.
And it looks like an AI stock, right? But instead it was weight loss. But it was one of the kind of key themes. Eli Lilly is one of the biggest stocks in the S&P 500, and it's been helping. It's one of the key contributors to the rally thus far this year.
You're right to make the AI comparison too, because besides AI, it was one of the biggest themes investors want to talk about.
Right, and so it had this big run up, right? And now what does it look like? I mean, if we were to, I don't have any of the AI stocks next to us right now, but it kind of looks like some of the tech names, right? You're seeing people pull out of stocks that have done really well to this point to either rotate into something else or sit on cash and decide what to do with it. But I think you can look at Eli Lilly in sort of a similar vein to some of the tech stocks in that sense of this stock has done really, really well. And now people are wondering, okay, should I take some profits here and move it somewhere else?
Redeploy it somewhere else.
So you can kind of call it the rotation trade maybe to some extent there as well, which I think is sort of a different way to frame it. And our third takeaway, small caps. Been talking about them all week, right? We had that historic run to start the week, and then Bespoke Investment Group was just out pointing out, basically we've erased the gains that we saw from Monday to Wednesday. We were talking a lot about that rally, and I'm going to get over to the Russell 2000 here, and you'll see that we really just didn't have, it was down over 2% today. If I can find it, where's IWM? You mind clicking on that for me?
Right there.
Go for it, Josh.
Right there. Nearly 2%.
Give it a click. Give it a click.
I feel like I'm getting
Give it a click. I want you to guide me a little bit. I don't want to. No, because we want to get to this, right? We can see that small caps had this big rally and then they started to come back down. And I just think the broad question right now is we've seen this a lot as we've been talking about will the Fed cut? We've had a big rally in small caps, then it sort of falls back. We had that last year. We had that earlier this year.
And very quickly,
is this going to stay?
When you talk to smart people, what do they say?
Smart people say once the Fed cuts is when they feel more confident in small caps. Note, the Fed has not cut yet. People are just pricing in expectations for them to cut. They think once that first cut comes is when people are going to feel more confident, and maybe we'll see more consistency in this chart moving forward.
All right, Joshua, thank you. More Asking for a Trend on the other side. It's been over a year since Bud Light faced a boycott that has left the company struggling to find its way back to the heart of consumers. Yahoo Finance's Brooke DePalma joins us now with the details. Brooke.
Yeah, good afternoon. Bud Light still taking a hit following that controversy that now is over a year ago. And competitors like Michelob Ultra and Modelo Especial continue to climb up in the ranks here. And if you take a closer look at dollar share, Bud Light is now in the third spot when it comes to overall dollar share for the beer market. And that's largely because of that lapse that we're seeing in that marketing controversy that happened last April. And the big question was if a year later it would still hold on to those losses. And it looks like it still has based on the latest data from Bump Williams Consulting. Michelob Ultra climbing to that second spot, and that's largely because consumers are really playing into the idea of a healthier, lighter calorie, lighter carb beer, catering to athletes and catering to drinkers who are really looking for a healthier alternative when it comes to drinking on the weekends. And that top spot, we saw Modelo Especial gain this top spot when it comes to dollar share last June, and it's been able to hold on to that. And there's two reasons why. Modelo Especial comes at a premium price point. So consumers are paying more when it comes to that brand. And in addition to that, it's also gaining more display space. It's gaining more distribution and availability. And we've also seen this rise of popularity when it comes to Mexican imports. So that's been good news for both Modelo and other brands like Corona. But the real truth here, the real full look at a year later will really happen when we see AB InBev, that's Bud Light's parent company results. They're coming out on August 1st. So when we hear Q2 compared to last Q2, we'll really get a full look at big picture how Bud Light currently stands.
All right, we'll be watching. Thank you, Brooke. Appreciate it. Now, from beer to pizza. Domino's reporting second quarter earnings this morning. The results mixed, with U.S. comparable store sales growing slightly less than estimates. Stock down more than 13% at the close. For more on what's going on in the fast food sector, we're bringing in RJ Hottovy, head of analytical research at Placer AI. RJ, good to see you. Let's start there with Domino's, RJ, because they report investors not happy. I thought this was pizza was the place to be, RJ. I thought, you buy a pie, feed the family, pretty good value. What happened here?
Yeah, I think on that end, you're exactly right. I think if we look at the numbers for just the U.S. alone, pretty strong numbers. You're talking about high single-digit comparable store sales growth, and that carryout business continues to do well. They're seeing success with the New York pizza. They're seeing success with more visit frequency because of Domino's rewards. Yes, the third quarter is going to be a little bit lower than the second quarter. They talked about that. There's some issues with some of their international markets, but I think if you take the foundation here, right now you're exactly right. It's all about value for QSR consumers, and Domino's seems to be striking a chord with them. So maybe a bit overblown. I do realize there are concerns about the international franchisees, but I think the U.S. business is really starting to get solid footing, particularly as it rolls into the Uber partnership and other things like that.
As you just mentioned, RJ, consumers are looking for value right now. We see a lot of promotional activity in this space. How is that actually faring? What's been the kind of the effect, RJ? Is all that promotional activity actually driving traffic?
Yeah, it really is. I mean, I think this is going to go down as the summer of value wars for the QSR sector, and really it goes back to even as far back as May. We saw both Chili's and Buffalo Wild Wings get pretty promotional. Buffalo Wild Wings had an all-you-can-eat promotion on Monday and Wednesdays. Chili's had a 3-product promotion, and so they kind of won the month of May. Flip the calendar, we go to June. Burger King and Arby's and Jack in the Box and Wendy's all try to front-run McDonald's with a bundled value meal. All of them saw accelerating visitation trends throughout the month as those things were released. And now we get to July, and McDonald's rolls out their $5 meal deal, and we've seen exactly that. We do have to strip out last year's Grimace Shake. That is distorting the numbers a little bit, but once we do that, you're seeing some pretty strong trends here. And so I think it really speaks to the idea that consumers are looking for value, and that's front and center for there. And if you can do it with some innovation too, like we talked about Domino's, some new products and other things like that, that's all the better. That's what really is striking a chord. Am I getting something different but at a competitive price?
Another thing I want to touch on with you, RJ, while I got you, is deals. Darden buying Chuy's. I'm interested, one, RJ, what do you think of that deal? Does it make sense to you strategically? And two, just more broadly, you think that's going to be a theme that continues to play out in this space, more M&A?
Yeah, another year, another deal for Darden here. And I think this one makes a lot of sense for them too. Not only does it fill a gap in their portfolio, obviously with Olive Garden and Longhorn Steakhouse and Capital Grille, they've got some well-established concepts. This gives them the #1 player in the casual dining Mexican space at this point. So really interesting. And our data doesn't show a lot of cross visitation between that. So what does that mean? It means a lot more incremental visitors with this particular acquisition. So I think it makes sense from that end. It's also a growth vehicle. And obviously there's not as much of that in the casual dining space. A lot of white space for this brand. And so I think that's a great pickup. And then like anything else, I mean, you're going to get some scale, particularly on the real estate and the purchasing side. And so I do think this will probably not be the last deal we see. I think we're probably going to see more consolidation in the space. It's gotten more expensive for restaurants to operate. And how do you offset that? You build scale. And so you do things like make an acquisition and improve your negotiating leverage. So I think we're going to see more deals, probably both across casual dining and quick service. I think there's going to be a lot more deals to come this year.
RJ, always great to have you on the show. Nobody knows the space better. Thanks for joining us.
Appreciate it. Thanks, Josh.
Stay tuned. More Ask for a Trend on the other side. We're looking at the ongoing uptrend in CEO confidence and what that means for interest rates in our chart of the day. Yahoo Finance's Julie Hyman joins me now with a closer look.
Yeah, this coming to us courtesy of Chart of the Day MVP, Torsten Slok of Apollo, who sends out a chart every day. And this one is particularly interesting here. It looks at CEO confidence, and the three lines here look at current economic conditions versus 6 months ago. That's the purple line. The blue line looks at expectations of how conditions are going to be 6 months from now in one's own industry. And then the orange line looks at how the conditions are going to be 6 months from now in the economy as a whole. Bottom line, they're all going up, right? They're all improving after we had a peak after the pandemic. Coming out of that, they slumped again, and now they're coming back up. And Slok looks at this as yet more evidence that the Fed is on the wrong track. He is in the same camp as Thomas Honig, who we talked to earlier today, who said that the Fed should not be too hasty to cut rates and that its messaging on rates has been a bit of a mistake. Now, Honig said that in part because he says there's still too far to go before we get to the Fed's inflation target of 2%. He also pointed out that because of the Fed's messaging, we've already seen a loosening in financial conditions that could then result in a resurgence in inflation. And Slok is saying something similar here. He says the market is making the same mistake it made in January when it priced in 6 cuts. And he says the uptrend in CEO confidence shows there's no reason for the Fed to cut interest rates anytime soon. In other words, things are still too hot in his view. Slok was one of the earliest economists to come out and say the Fed was not going to necessarily cut rates at all this year. And that was a time when everybody thought they were going to cut multiple times. So we'll see if he is still correct here, although the Fed's messaging has certainly changed on this front.
All right, thank you, Julie. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.